All right. Hello, everybody. Welcome to the SaaS Camp for Vendor Capital for 2023 Spring Edition. This is the second day that we're having today. We just heard from Tavi Kotka and Sakarit Pihlava on Monday. And now today we're going to talk with, or actually we're going to hear from Hannah Meiton. And she's going to go through her lessons and experiences on healthy growth. But while we wait for people to still come online, we will go through just a couple of housekeeping items. Just to introduce myself, maybe this is a good point. My name is Timo Felin. I'm from Vendor Capital, and you are likely very familiar with us already joining this session. But nevertheless, I mean, we are a B2B SaaS focused fund based here in Helsinki. And we do pre-seed to Series A investments with a very keen eye and love for especially late seed investments, 1 to 2 million roughly. But yeah, feel free to send your pitch decks and whatnot to us. We're always ready to spar with founders. But in terms of this session, we want to have an interactive one. We're happy to get any kind of questions throughout the session. You can do that in the Q&A tab here. Just post it over there and we'll see it instantly. And we can take them on as they come, you know, throughout the slides and throughout as Hannah will be speaking. We will naturally, as always, have a Q&A session at the end as well. So if you feel like waiting for that, that's fine too. But we'll have a chat with Hannah and we have an opportunity to ask her questions at the end as well. But always, if there's a topic or a question that's related to the topic at hand, then please bring it up. If you chat, you feel free to do so. Share your SaaS mood for today. Just make sure that the message goes to everyone. There's a little tab at the end or a little selection window there. And our intention is to share the slides. So I have a feeling that many of you might want to study these after the session as well, but feel free to take your own notes. We don't mind, and we actually encourage that. But I think we're ready to get going. So to all of those who just joined, welcome. This is the second day of our 2023 Vendor Capital SaaS Camp Spring Edition. And we have Hannah Meiton here from Ampli Ventures talking about the lessons on healthy growth. We're going to talk about things that are, I'd say, more topical and important than ever. Given the turbulence that there is all around the world, and especially in the SaaS world, I mean, you're looking at failing banks, you're looking at diminishing multiples and kind of waning customer interest on some sectors. It's like profitability and health. And let's say healthy growth is really back on the menu here. And Hannah Meiton, she will be our captain today, let's say, as we lift off. And we'll be talking about the lessons she's accrued over her lengthy career. She's worked in several fast-moving roles within great SaaS businesses in Europe and also across the ocean in the US. And she's built a really solid base of experience to talk from. But I will let her do the talking and further introduction. So please put your seats in the upright position, you know, fold your tray tables and buckle up. And Captain Meiton, go ahead and take it away.
Thank you very much, Timo. Hi, everyone. Thanks for taking the time out of your busy day to join us and listen to some of my experiences. And hopefully we will take away some good points here that will inspire you in your everyday work and hustle of building extraordinary SaaS companies. So yeah, as Timo said, we're planning to spend the next hour on the topic of kind of navigating uncertain times, how to achieve that balance between growth and still invest but yet remain lean. And since I don't have any context around who you all are, I will focus on sharing my experience and thoughts. But I would love, as Timo said, to make this as interactive as possible. And I'm also really glad that Tim was here with me in this discussion, kind of co-leading and moderating it. So, but let's try to make this as interactive as possible. This session is for you, not for me to just go blah, blah, blah. But let's steer it in the way that you feel is really valuable. But before we get into the topic, I thought I'd kind of introduce myself. So I'm Hannah Meiton. Today I'm the co-founder and partner of Ampli Ventures. And my background is I started in SaaS in 2005. I was living in London and I joined a small company called Meltwater. And what we did was basically selling an online subscription of media monitoring. It was super hard cold calling with no marketing. We didn't have any fancy SDRs, or we did everything from prospecting to demo to close to implementation of the service to account management to renewal. So extremely manual as it was back in 2005, but it was really hard work, but very humbling. But I think it taught me at an early stage the full funnel from sales and the entire customer journey. And 6 months into the job, I was part of the team moving over to Silicon Valley to open up the US market for the Norwegian company. We simply bought a one-way ticket and rented a house in Castro in Mountain View and a small office. And we just got going, essentially just picking up the phone. We figured that if it had worked in Europe, it could work in the US. It sounds a little naive, and it probably was, and I think time has changed, but it was truly learning by doing with very little prior preparation. And it still is until today how I believe is the best way of doing something new. And I'll speak a little bit about that at a later stage and get back to that. So 3 years into the US, and we had opened about 10 sales offices, we realized that we were terrible at taking care of our customers. So I kind of raised my hand and I said, I'd love to focus on this. And we put together a team that set an upsells and renewal methodology in place. And then I kind of picked the best salespeople from our sales offices in the US and formed an East Coast customer success team where our goals were super crystal clear. And this was pretty early on, but we had a crystal clear focus on a 90% logo retention annually. We shouldn't lose more than 10% of logos or customers. And then we had a 40% revenue increase, aka upsells. So we wanted to really increase our customers with 40%, which is very aggressive. But again, going back to our sales mentality, I think that is we learned a lot during those years how you can go about actually from day one focus on increasing net revenue retention, and we'll come back to that a lot today as well. So I spent almost 7 years in the US opening sales offices, setting a customer success methodology. Then I worked in the product development team, and then I switched company to a brand new SaaS company where I was part of setting pricing, packaging, and the customer success team, and built that from scratch. And very quickly, 2 years after we launched the SaaS model, it got acquired by Google. And I think that what I really took away from the US and the years that I were there is that everything is possible, that every time you meet an American, they're so enthusiastic and they're so possible, and they go, yes, the answer is yes, what's the question, kind of thing. And then I learned a lot of grit. I learned a lot of resilience and working hard. And I think that really became a big part of who I am today. But boy, I was pretty tired after 7 years in working in software tech and growing companies in the US. So I took some time off, and then 10 years ago, I landed here in Stockholm, and I became the first VP sales at iZettle, who at the time were a Swedish company, very focused on the Nordics. And my job were mainly focused on market expansion, but also go-to-market strategy, really making sure what sales channels should we be focusing on, and what's adding not just top line growth, but really underlying profitable growth. as well as customer relationship management, customer support, supply chain. So everything customer interaction based I was handling over at iZettle. And then my last kind of operating experience, if say so, was at a company called Soundtrack Your Brand. It was a Nordic company that had a product called Spotify Business, so background music to hotel, restaurants, retail. The focus was really on enterprise customers. I, together with the team, kind of drove the transformation to an SMB focus, where we developed a global product and launched that into 77 markets overnight, and transformed the company to a product-led growth, self-service company. And we grew from 2,000 customers in Sweden to 22,000 customers globally, where about 60% of them were US based. So, and since then, I've also focused on sitting or sit. I always say that you should never say that you sit on a board, but I work in boards. So as you can see here, Mentimeter, Cognity, F-Track, and surely all ears and Videoly. And I think a common theme is that capital efficient growth, actually, which is rare these days to have experience in. I worked in bootstrap companies, focused on market expansion, sales, go-to-market strategy, and really making sure that we know everything, what's driving growth and what is driving underlying profitability. So I've been deep down into a lot of cohort analysis and Excels. So that's a little bit about me. And today I'm the very proud co-founder and partner at Ampli Ventures. And for those of you who don't know who we are a rally newly started. We started in 2022, so just last year. We're a SaaS B2B investor, just like Vendip, and we're at seed and Series A stage. So how that translates to us is that we'd like to start investing in a company when they are about 1 million in ARR and growing, of course. And we're based in Stockholm, but we focus on the entire Nordics. And we're focused on helping SaaS companies and operators in the stage where we believe companies not only need capital, you don't just need money on the bank, but you also need a lot of operative experience and competence to kind of avoid the common pitfalls that we have done and that companies take during this most challenging time, where you need to set some processes, make sure you find a scalability, hire new people in there, go to other markets, and so on. And that is around 1 million euros typically, and you're kind of really pushing the pedal to the metal, and you're trying to grow quickly as possible to 10 million. So some of our investors that have invested in Ampli include SaaS entrepreneurs, CEOs, and the founders who have built and are running successful SaaS companies themselves. So, and what we see is that this is kind of a giving way back to the ecosystem to make sure that we provide their competences and skills and capital to bring out the new generation of Nordic SaaS B2B unicorns that I'm sure you are part of that group. And some of our portfolio companies here so far, you might recognize Videoly because it's a company that Vendip early on invested on, and we work on the board together with Timo's colleague, Tupa. So part of our methodology, and I know this is a super heavy slide, but actually I'm going to go back here. Let me see here. So part of our methodology and framework on how we work with our portfolio companies is really what we're going to be talking about today. It is essentially, we have developed a framework and a set of indicators that companies can use and drive the business. And we really advise founders to make sure that they're not just tracking these metrics, but they're really kind of striving to try to get in within as close to the benchmarks that we provide and that we believe are best in class to drive a capital efficient growth SaaS company. And so a lot of the discussions that we have with the companies that we've invested in and all the founders that we speak, it's about how do you balance that act in investing in growth while remaining in a capital efficient mode, meaning essentially that your bottom line is not growing exponentially faster than your top line growth. It sounds very easy, but we all know that this is basically one of the toughest things that I think you can do in business. So when we start working with a company, part of our due diligence is that we really map out the market. We speak to a tremendous amount of customers. We'll speak a little bit more about that as well later on. And then we provide a blueprint of recommendations and areas where we would like to spend some even more time with the founders and focusing on. And then together with the company, after the investment is done, we put together a strategy and a plan where we can focus our time on the areas where the founders feel that they also want to improve and work towards. And that could be, just like I mentioned here, new market entries, or new market entry strategies, a little bit of spelling there, CS methodology, go-to-market tactics, pricing, packaging, product vision, and kind of setting the right KPIs. And so we have we have set together these set of data points and benchmarks, and this is not,
sorry to butt in here. I mean, we've been encouraging, and for everybody who joined kind of late, we've been encouraging everybody to kind of feel free to post questions. And now that we got one, I gotta make sure that you're here.
Should I skip back or
No,
No?
yeah, maybe. Perhaps it might be related to this as well. I mean, there's Anton asking over here, what are the kind of most common pitfalls that you've seen in late seed, pre-seed, early seed, kind of SaaS startups? It's a very broad question, of course, but maybe you can highlight kind of the most, the ones that you kind of meet most often in the companies that you either invest in or you talk to.
Yeah, I mean, I don't want to say common because I think that's a little bit belittling to founders out there, but some of the companies that we've kind of giving feedback back to, I'm just thinking here ahead, but I think that one area is really what we're about to start to talk about, and it is knowing your metrics. And I think that most founders and most companies, they know the usual suspects in terms of top line growth, churn and CAC LTV. CAC LTV is not a big favorite of mine. I think it's pretty redundant in general. I'd rather talk about more payback time and stuff like that, for example. But if you go one step down and you talk about what is driving this underlying growth, what are the key kind of main drivers that will result into the hockey stick growth trajectory that you're forecasting in, I feel like it's many times an Excel workshop more than an underlying discussion within the company in terms of how are we going to achieve this growth, more so than just putting a 0.2% driver into an Excel sheet, and that results into a 3-year growth into a 5 million. So I think before you start excelling out a forecast or a growth path, you need to really spend some time in a war room, understanding what's driving the underlying business today, and what are some of the bets and investments that we need to do in order to really succeed with this plan. I think that's one part, and we'll talk more about that. But maybe that is the most important part at this point. So really try to get to know your business and inside out, and make sure that you're aligned in terms of what do you need to do in order to deliver the underlying drivers in your forecast.
Yeah. I mean, you have metrics, but they're just kind of a frame or framework to help you
Yes.
find the insights and where to focus on and what to really look at.
Yeah.
And when you're
Yeah.
doing your forecasts, I mean, you need to make sure that you're doing them based on what you believe you'll be able to achieve, not the other way around. In a sense, you create
Yeah.
or forecast first and so forth.
Yeah.
Good answer. Thanks.
Good question, Anton. I could talk for another hour about some of the things, but I think that is the big takeaway from there. Any more questions, Timo? Should I?
I think that's it for now. But
For now, keep on coming. Yeah.
Keep them coming. Exactly.
Yes. Yes. So kind of going back to this, and I like Adrian and myself, who I'm running Ampli, we didn't make up these numbers, obviously, needless to say, but I think it's important. So this is publicly available SaaS KPI benchmarks. They come from the KeyBank report. They come from the OpenOcean. They come from, a number of SaaS reports are available out there. And if you're unsure where to go, let me know and I can send you hundreds of them. So the benefit out of very many by really working together with Adrian, who is much smarter than me, is that he has a very data-driven approach. So what we have done is aggregated all the reports that we could find. And we've also aggregated kind of these numbers from the companies that I am working with and that Ampli have invested in. And we've put together kind of like a benchmark to what good looks like. So it's a combination of a data aggregation with our experience that have boiled down into these key metrics. Now, you might argue that these key metrics depends on a number of factors. Where are you in your capital raise? Where are you in your growth journey? What markets are you in? Are you driving an enterprise company or an SMB focus? And yes, and there's no right kind of saying if you are at a new logo, if you're only growing, 78%, but you have existing customers growing 22%, is that bad? No, of course not. This is a framework and this is a benchmark to where you should kind of make sure, first of all, are you tracking these metrics already? Do you know even where you are? And when it comes to these areas of metrics, then if you're not, you need to basically start finding out, because it will really unveil and learn so much about the businesses. So we do this exercise with all the companies that we invest in to kind of map out and set a baseline to where you are today, and unveil some of the weak spots, some of the opportunity, and some of the strong areas. And that also forms kind of how we should be prioritizing our time and how we should be really focusing on improving the weak spots there. And we're not going to go through all of these. We're certainly not going to discuss all of these, but today we're going to be focusing on 3 themes. And those 3 themes is top-line growth. Basically making sure that even though you're not going to raise that 50 million euro Series A round at a valuation of 45 times your ARR, because the market will not allow you to do so. You need to really still continue to drive a pretty aggressive growth when you are at these early stages that I assume most of you are at, basically pre-seed, seed, and so on. We'll then also focus on net retention. I'm sure you all very familiar with NRR and so on. But we'll talk a little bit about the underlying drivers and basically what is causing a great net retention and what are some of the things that you need to do in order to make sure that you set your company up to achieve a net retention of 110, 120%. And then we'll talk, of course, about capital efficiency. And that is mainly at this stage around how can you build an organization that is super clear, crystal clear, focused. Everyone is spending every minute all four are pulling towards the same direction, which leads to a very, very efficient organization and a low burn multiple. And I'll explain how we look at this and some of the kind of basically some of the tools that you can be using to calculate capital efficiency. So I'm just going to start kind of heading straight into the first one. And that is around top-line growth. And as you see here is that the bottom line here is that you're still at the early days. You know, you're trying to build a really robust customer base, but you don't have a robust customer base yet. So therefore, you really need to focus your main focus on new customer acquisition to continue to grow. And how do you sustain a kind of 100% growth year on year while slimming down and reducing the number of bets that you can take and the level of marketing investments that you can afford? Well, what we really typically advise our founders is to really narrow down the focus. And what does that mean? It means that make sure that if you haven't already, you nail your ideal customer profile, nail your persona, and the key problem that you're trying to look to solve. Don't try to be a product or a platform or a solution that can tailor to any vertical, any segment, any type of customer in the organization because your product is so great and flexible and agile. But really pin down and try to identify who is your main customer, what is the key pain problem that they are facing, and how is your product solving their pain problem, their problem, in a much better way than your competitors are doing. And once you've figured that out, you also need to figure out how you communicate to customers in a way that they understand that it is your product and your service that solves their pain problem the best way ever. And you need to make sure that they understand that in a very quick way, right? Because our focus these days are very swift and it's hard to really get in front of customers. So how do you do that? Well, you do that by spending way much time than I promise that you currently do with your customers. Because you need to become extremely customer obsessed in order to get almost inside their skin in terms of why are you using my product? What is making your life better with my product? And ask those uncomfortable questions that might be hard to do yourself because you're really biased. And we'll talk a little bit more about that. But what we always do in when we kind of commit to due diligence with a company, we focus a tremendous time on doing an immense number of customer interviews. We talk to customers that are happy, that are unhappy. We talk to customers that have churned. We talk to customers that have chosen another solution. We talk to friends that have never heard of a product, but that could be potential users. And we really spend most of our time actually in the commercial due diligence is really trying to be vacuum cleaners in terms of trying to absorb knowledge into this area and segment. And the insights and findings that we get from all those interviews, we then package and present them to the founders at the due diligence. And so far, in each and every single case, regardless if the founder is viewing themselves as customer obsessed, is doing everything right, spending a lot of time talking to customers, the founder always says, wow, we need to do this far more often. We need to spend more time with the customer. We need to really discuss their ins and outs and their needs in order to get a better understanding how we can provide an even better product and a better experience.
Well, if I can butt in here,
yeah,
question like your thoughts on on several companies can be in the situation where they are doing exactly what you just kind of hinted there, that where they're serving kind of a large market, they're serving everybody, and they haven't kind of picked their ICP, they haven't really focused on a specific market or in the market to really start gearing their product towards and really finding the value that they can bring to those people. Do you have any tips in terms of like how would you go about picking the one that you want to focus on?
Oh, well, I do have lots of ideas and thoughts and tricks, but I'll give you an example of how I did it, basically. So I told you about when I was at Soundtrack Your Brand, we launched a global product with a self-service. You could sign up online, and we kind of launched it in 77 countries because we could. And it was a little bit of an ego. Whoa, we're global overnight. And my hypothesis is that let's go wide and kind of cast the net wide here and see what's picking up. And then we could really kind of focus on the markets where we see that there's a higher interest, conversion, and loyalty. And that kind of goes back to, rather than us doing lots of research, desktop research, hypothesis, market studies, and so on, we try to quite quickly go into a growth mindset, kind of develop a hypothesis. How can we test this with a minimal kind of viable impact, and then double down on where we see an increase? So we spent a lot of, well, first of all, we kind of opened up the product to all the markets. We remained open in all the markets, I should say, but we were super combing through data with a fine-tooth comb, and it was me and an analyst, and then sooner kind of a business intelligence guy, trying to ask, okay, where are we seeing lots of traffic? Where are we seeing an increased conversion? Can we ask them what segments that are using? Okay, they're hairdressers in Brazil. Okay, what kind of music are they playing? What are they signing up for, annual or monthly? So we were really trying to comb through every data that we could get. And did quite a lot of analysis to see what customers are costing us the least compared to what they're giving us. And you'd be surprised that most of the time customers look at the top line and they see, oh, we're getting a lot of traffic from, I don't know, hairdressers again. We're seeing that they're signing up, they're starting to use the service, thumbs up. And that's where the analysis kind of get to a halt. And if you do that, you're kind of shooting yourself in the foot, because what we realize is that hairdressers, not to say anything bad about hairdressers, but they're pretty flighty, because in month 2, they had churned because we had a 1-month free trial. So by month 2, they had churned, whilst we had a much lower conversion on restaurants in Germany. And we saw that we didn't have that many coming to the site. We didn't have that many actually signing up, but the ones that signed up, they were customers for life, which obviously meant a lot in terms of how we can prioritize our spend in terms of paid performance marketing, how we could really kind of be more flexible with how we set pricing and packages and campaigns and promotions, and how much time we could spend on individual customers. So hairdressers in Brazil, we couldn't spend any time on them. And we actually bumped up the price there to almost deter them away and make sure that we got the unique economics to it. But restaurants in Germany, we applied an onboarding call to them to reach out, welcome them, and to get them even more vested. So I think that's an example. I have a few more examples, but that's what I mean with develop a growth mindset here. And when I say a growth mindset, is that you try to really develop hypotheses, and then you try to test those hypotheses in a very kind of quick and agile way to see what you should be prioritizing your time on and what you should be spending more money and resources towards. Perfect. And so after you've spent more time than you think on talking to customers and starting to map out and start having that as part of your cultural DNA of a company, you will probably, and you start focusing on, okay, this is the customer in this vertical or in this segment that we're focusing on, and this is the key thing that we are solving for them. And then there are lots of other bells and whistles, but you don't have to kind of say them all the time, because that's another thing that I'm noticing. Founders are you're so proud of your product, which is amazing. But sometimes by just rounding up all the features and capabilities your product have, it gets lost. So rather say one thing that you do awesome, and then you can tell them all the things that you do well at a later stage. Because the findings that you will get from talking to customers and focusing on your ICP is that you have to go through and revise your value proposition, really making sure that you review all your communication on your website, really make sure you identify the key buyer and users and use their lingo to communicate how your product is helping them. And by doing that, you will have probably a much smaller funnel, but a much higher conversion, which will lead to a much more efficient customer acquisition. More questions on that, or should I skip over to next subject?
I think we can move forward in the
Yeah.
interest of time.
Yes, I just realized. Oh my God. Yeah, sorry. So here we go. Okay. Net retention. Why is this important? You all know that this dollar retention is so important. So make sure that you don't just invest, but you overinvest in customer success, and you build out a product that enables upselling, regardless whether this is through adding more users, adding more data integration, increasing volumes or requests, or adding more modules. So if you look at really super SaaS success superstars out there, Snowflake, Marketo, Zendesk, they all have super impressive net revenue retention. They're often above 150%, which kind of really separates fast growing, amazing SaaS companies versus the one growing at, say, 105, 110 year on year. So a lot of companies that Ampli looks at, they say have tremendous top line growth, very low logo churn, but the NRR is still around a 99 to 100%. Well, what is that? Well, in my experience, mainly is because they focused on building a product, building a pricing package that doesn't really scale, because it doesn't allow your customers to buy and spend more. This means that once you have gotten a customer convinced to buy your product, they choose a package, and then that package is forever their price, excluding price increases, of course. So regardless if they have what they think of your product, NPS a 10, right? How much they use or how often they use the product, there isn't any way for them to spend more dollars with you, which is obviously such a big loss of opportunity. So on the gross dollar retention, we typically want companies that we invest in to be kind of a max annual logo churn of 10%. If you're selling into the SMB segment, especially the long-term, kind of long tail SMBs, we think that the logo churn can go up even further. That's just the pure nature of the customer profile. But if you have anything close to 90% or above of retention, you're doing really, really well. However, if you're unable to reach above 100% in net dollar retention, or even close to kind of 110 or 115, your product development is just not keeping up. So you kind of build the product, clearly solving a problem for your customers that they find valuable enough to invest in, and they're not churning, so they're eager to pay money for it to solve this. But then your continued vision should not be to do more of the same. That's just not good enough. You need to make sure that you have a product vision that allows customers to spend more time and money with you. And in the interest of time, I'm gonna kind of skip over to the next one, unless Timo, you feel like it's something super important that I've failed to mention here.
Well, no, not as such. I mean, everybody should know what NRR is, and I'm not trying to shame people who don't know, but
no, that's good.
There's just a question on what is NRR, but just simply defined for those people who don't know.
Yes, I'm sorry.
Revenue that you're getting from customers this year that signed up last year or the last period or whatever. So it's just new revenue or upsells and expansions and things like this that you're.
Exactly. And I hate when people use lingo. So my bad for throwing that out there without explaining it. But if your customer spent $100 on your product last year and they're continuing to continue to be a customer this year, if they're spending $100 this year, your NRR is 100%. If they're spending $110 this year, your so-called net revenue retention is 110%. So that's how you should think about it. And if they're spending less, it obviously goes down below 100%. So that's just basically. And main key takeaway here is that you need to make sure that you build out a product that allows customers to buy more and to grow with your customers. And I think pricing and packaging is such a dynamic way of steering customer behavior that you should constantly kind of review and challenge if your current pricing and your current packaging is the best for you in the stage that you are. So I think those are the two key takeaways from here.
Yeah. There's a question here on your experience on inside conversion rates, like cross-selling conversions for SMBs. Do you have any experience on those by chance?
No, it really depends on if you're selling a product flora of different modules. Then I think that you should have like a fully utilized kind of goal rather than a conversion. So if you have a land and expand strategy where you're selling one module, but as you kind of customer come on board, your intention is to sell more modules to kind of build out the product flora, then I think what is fully utilized for you, and maybe that is a customer not buying all of them, but say that a customer is buying 75% of our complete product, then that is your fully utilized goal. And then you should make sure that your customer success team is tracking towards them, that rather than looking at conversion.
Yeah, that makes sense.
So we need to have some time for questions as well. So I'm going to skip the summary slide that's after this. And then this is my last slide, and I'll of course keep this rather swift. But I think there's multiple ways on calculating efficiency. And I think capital efficient growth does not mean frugal, pulling the brakes on everything. And these days, we actually see a bunch of companies that have pulled the lever way too hard, meaning that they're actually spending less than they have cost budgeted for, which means that they're not investing and focusing enough on sales and marketing to kind of reach top line growth. And I think that different ways of calculating efficiency and to kind of make sure that you're not outspending your growth is, for example, there's a few ways of you doing that. The most common way in Timo's and my world, investor world, is something called Rule of 40, which is essentially the sum of your growth rate and the sum of your profit margin, and that should exceed 40%. So if you're growing at a 60%, you can have a profit margin of minus 20, and you kind of get at that. In an ideal world, you will have a profit margin of 40 and you grow 40, for example. But there's different ways of reaching that. How the hell should you translate that into operational efficiency, and how should you use that? Well, you can. So as an operator, the rule of 40 is the only time you use that KPI is when you're talking to an investor. So don't try to incorporate that internally as a key metrics, because people will get so confused. I think burn multiple is a much easier way. It's a very simple but effective way of measuring efficiency. It's basically taking consideration of well, basically, you need to, every dollar the company is spending, what revenue are they adding to the business? So if you're spending more than $2 to every dollar that you're adding, then you need to make sure that you kind of pull down on the costs, I would say. So it's about how much bigger is my spending than my growing, how much is my bucket leaking, and depending on your capital strategy, you can adjust that. I really like the ARR divided by FTE. How much annual revenue do we have per FTE? So because that's something where you can really control and track over time as you grow. And it's also easy to see why is it kind of going down? Well, because we just added 10 salespeople, but we were seeing in 6 months' time when they're fully ramped, we'll have a much higher efficiency. And if we don't, we're doing something wrong. That is something that I always urge all the companies to take internally as a kind of a way of calculating efficiency internally. I say here that do things that don't scale and hire for the job, and maybe that's a different session, but I think this early stage, you need to focus, you need to make reorganization as part of your culture. Because if you grow in the early stages, you're constantly kind of outgrowing your suit, meaning you're constantly outgrowing your talent and your organizational structure and your hierarchy and the titles. So you almost need to constantly revamp the organization every 6 months. And that is painful unless it's a true part of your culture. So try to build an agile, kind of nimble approach and culture to roles, responsibility, and structure, and make that part of your culture. Because if you cement your organizational structure and the roles and the people and the talent that you have too early on, it will become so painful as you outgrow it and you need to add more competences, experiences, because all those people will feel left behind and they will feel demoted. So with that said, I had a summary slide. It's just repeating what I already said. And I'm just going to hand it over here to see if we have any more questions.
All right. Yeah, we have one question that was left over from earlier on related to pricing, but in general, I mean, guys, please do post your questions here. I have a couple actually that I wanted to run by you related to the topics that you also mentioned. And perhaps we'll quickly take this question that was already on the board. So related to pricing in terms of how do you see, the question is if you charge three times on costs and customers accept the price, you can grow healthy, but what is a good multiplier for a SaaS company? But I guess we're talking about gross margin here a little bit. At least it was there on the board that you shared.
Well, I think when it comes to pricing and being able to charge something and not, I think you should definitely not undercharge. But typically, if you price yourself too high, you will really narrow the addressable market that you will focus on. So it will prevent you from growing as fast as you'd like to do. Because for some customers or potential customers, you will be too expensive. Now, if you have a total addressable market who's completely non-price sensitive, and the initial hurdle and the initial sales cycle is pretty short, then I'd say price away. But I haven't, and if you're that company, I really want to talk to you because that sounds amazing. But I haven't seen any company in that phase. But so just think about, profit combined, like, are we optimizing for profit or are we optimizing for growth? And how do we kind of balance those two?
That makes perfect sense. And in general, I mean, the gross margins for good SaaS businesses, I mean, Hannah just posted those kinds of numbers, 70 to, or let's say 80 to 90% roughly is where you want to aim. But that of course depends on your business. But in general, I mean, when you're doing pricing, you're constantly evaluating that, you're constantly renewing that, and you need to be. And also you need to follow a certain kind of procedure in order for you to actually come up with pricing that will work with your customers. So make sure that you research it before you start, and try it out, A/B test it before you actually fully go live, and keep constantly iterating on that.
Yeah, and get inspired by competitors. I mean, don't shy away from that. Yeah,
exactly. Well, actually, we have a great SaaS Camp session on that from Solo. So feel free to look on our YouTube channel for that. So hey, related to a couple of things here. So one thing I wanted to talk about was kind of, you mentioned on the ARR growth side. We constantly meet companies that have kind of these legacy products that they've built earlier, and that they've been kind of able to build a customer base that has like a few €100,000 of ARR. So it's a nice ARR base, but for some reason it's not growing. For instance, like it's doing 20% month on month. It's not month on month, but year on year, and the companies, they want to start developing a new product on the side to kind of achieve the growth that they're envisioning, and that you would like to see in a SaaS company to get it kind of on this venture track. So what's your kind of advice there? I mean, how much should they double down on that growth if they have on the growth potential in the other market, if they have the other kind of legacy product on the side, and should they kind of slowly die that out, or keep working on that? Well, I mean, how would you look at this kind of a situation?
I mean, there's no right or wrong answer. I think first of all, you need to make sure that you're fully transparent and you have that discussion all through the company, and you really align expectations and demands all the way from board level and ownership level down into, every single operator, is that this is our core focus, this is our priority, and this is how much time and effort we're going to be spending on that. And also you have the discussion, and that you're very well aware of the cost that it will have, basically the alternative cost it will have by not focusing on that. So I always urge team to, when you put a strategy down and you say we're going to do this and we're going to try and do this, that you also jot down and you say we're not going to do this, we're not going to do that, and we're not going to do that, and you're aware of that, the result that this will happen. Because it's extremely hard working in an organization and focusing on things that will result in a negative effect on everything that you've worked on for your entire life, or for the last few years, right? So if you see sales slowing down even further, you see NPS scores, you maybe see customers churning, and although that is a deliberate effect by spending less time on your legacy product and your legacy maybe ICP, is one thing to say it, but it's another thing to go through it, because it just goes against everything in your DNA, right?
Yeah.
So one key solution to that might actually be to change the KPIs, the internal KPIs that you're measuring. So instead of seeing red numbers and kind of down trends on measuring the legacy, to just try to focus on something new. I think, and then by focusing on that, you'll much clearer be able to take the correct decisions and make the right priorities to the new future you.
Yeah, that makes perfect sense. You're another Hannah here, thanking you for the session. So
thank you. Hi, Hannah.
We echo her, of course. A question here, I mean, perhaps not related to B2B. So how valid do you think this information or these KPIs are for B2C SaaS startups?
Yeah, I think you can cherry pick them. I think that a lot of them are still valuable. Uh, but having said that, the main difference between B2C and B2B is obviously B2C is about volume. So you need to make sure that you're not losing sight on really volume, because you typically have a much lower ARPU, average revenue per user. So you need to get a ton more users. And that in combination to individuals and consumers are much more flighty. They're not as loyal, and you will have much higher churn numbers, much higher than the SMB focus that we talked about before. So it's typically about making sure that your CAC is maybe even more efficient, and you can bring in more volumes. And B2C is about a volume game, meaning that your funnel should look like this, because if you're building a B2C product and your funnel looks like this, you're not really capitalizing on the opportunity top of the funnel, I should say.
Yeah.
I'm not an expert though. I'm B2B, blood, sweat, and tears.
That's right. Same here. Perhaps I'll go into a question kind of related to the. We've been talking kind of about these aggregate higher level metrics, and sometimes they can cause confusion with the founders from the many options that they have to try to pinpoint the causes underlying the metric. So maybe the question here is like, where would you start digging first if you had like subpar NRR? I mean, have you run into cases where you've had the NRR drift to sub 100% levels, for instance, and you're suddenly kind of operating this kind of a leaky bucket situation? And where would you kind of start in order to remedy that situation?
Oh, for sure. I mean, I'm working with one company, not part of Ampli's portfolio, I should say, just for the clarity of things. And they have a tremendous top line growth, and they're constantly selling to new customers in a much efficient way and so on. But they're churning a lot of customers. They have like 25 to 30% churn. But because the sales team has been so damn efficient and so damn good at constantly adding new customers, that has not been very visible, that kind of leaking bucket. And we also, because we've been through a transformation of charging customers more, so we get a higher average contract value, and we're also better at upselling. So if you didn't really break down and looked at the different numbers there, if you were only looking at net revenue retention and not logo churn, you wouldn't realize that we're losing 25 to 30 customers because we have a net revenue retention of 110. So you have to know this, because once you kind of get to the inside of that and you realize, oh, wow, we're losing a lot of customers here. And then deep dive into a churn analysis where you find out who are these customers. Are they customers we want to, or what kind of behavior have they had prior to churning? Have they indicated a bad fit, or a low NPS, or less engagement? So that's the first step, and then you can put a strategy on how to mitigate it, and how you should go about it.
No, that makes perfect sense. I mean, it's not always easy, but you definitely need to get down to the bottom of how these metrics or aggregate metrics work, and kind of nitty gritty in a sense, in order to really understand what drives them there. So there's a question. I mean, you mentioned that you do reorganizations even every 6 months, so that's quite often. Can you deep dive into this a little bit? Like, what are key points here?
I think reorganization is not the ultimate goal, but I think it's just important. It's just a mindset that don't spend too much time perfecting the perfect org chart or the matrix that you guys are going to do on vision and missions and all those things, because it will change. So and I think it's more about a culture kind of mindset, is that yes, as we grow, people will get new roles and responsibilities, and people will get new managers, and people will get different layers. And that is, at the end of the day, it's because we are growing, we're doing something right, we're being successful. It's not because an individual is doing something wrong. So if you can have that as part of your culture DNA and corporate DNA, and you can discuss these things, then when that person is being demoted because the company is growing faster than that person's competences, or you're doing a reorganization because of a strategic initiative, that individual person feels like this is not a super big deal, because we might actually change again in 3 months or 6 months. And it's also for the good of the company, essentially.
Yeah, it's just a very dynamic situation, dynamic environment that you need to create, or culture, as you say.
Yeah.
That you need to create in the company, so that everybody
Yeah.
understands that nothing is set and everything's constantly in motion. Yeah.
I think Mentimeter, I've worked with them for 7 years. And I think he's stolen a quote from I think Spotify or Apple, I don't remember which one. He says the only thing constant with us is change. Yeah. We will continue to change forever. And I think it's so true, and it's so good to have that with you. But it's beer o'clock in Helsinki, so I'm gonna thank everyone for their time and for sticking it out this much. And feel free to connect with me and ask me follow-up questions and so on.
That's right. Major thanks, Hannah, for this deep dive into creating this kind of a healthy growth that enables building a foundation for these winning SaaS businesses. So we will return with other topics again with next SaaS Camp. If there's something specific you'd like to, cover us to cover, then feel free to reach out to us. And of course, last but not least, thank you all who joined and for the participation. And we really look forward to bumping into you in the future. And you just guys have a great evening. It was great having you here, and we'll be seeing you.
Thanks everyone. Bye-bye.
Bye.